Good morning. Welcome to today's discussion of the role of minority depository institutions and financial innovation in the age of COVID-19. My name is Tom Miles. I'm the Dean of the University of Chicago Law School. On behalf of the school, our Sandor Institute for Law and Economics, the Becker-Friedman Institute for Economics here at the University of Chicago, and the American Financial Exchange, it's a pleasure to welcome you to today's discussion. Today's event follows an inaugural collaboration in April 2018 that convened University of Chicago faculty, regulators, and market participants to discuss the future of financial benchmarks. At the University of Chicago, our faculty pursue bold ideas on matters of social consequence. In an environment dedicated to free expression and inquiry, they're unafraid to challenge conventional wisdom. As a result, the university has been home to many intellectual breakthroughs, especially in the area of economics and finance and law and regulation. Economic thinking at the University of Chicago has always aspired to combine intellectual rigor and empirical testing with policy relevance. Whether it's a breakthrough or evidence-based research, the ideas of our faculty are not meant to be confined to campus. They can and should have impact on the world. They have influenced, even reshaped, how markets are organized, which markets exist, and how they are regulated. This series of discussions continues that ambition. Business leaders and policymakers face difficult choices on complex questions, especially in this age of COVID-19. This series focuses on the intersection of banking, regulation, and innovation. I look forward to the ideas that will emerge from these discussions, as well as the new opportunities that will result for them. Opportunities to make, we hope, our economy stronger and our world better. Again, welcome. And to begin our program, it's an honor and pleasure to introduce our moderator for today's discussion, Dr. Richard Sandor. Dr. Sandor is the ideal person to lead any discussion on financial innovation and minority depository institutions. Dr. Sandor is a strong advocate for providing minority-owned businesses with access to capital. Last week, in an op-ed in Crain's Chicago Business, he issued a call to action for the financial services industry to expand lending to minority businesses, businesses that have been disproportionately harmed by the COVID-19 pandemic. Dr. Sandor is also a leading innovator and entrepreneur, and throughout his distinguished career, he has introduced many financial innovations of tremendous importance. In the 1970s, he developed the first interest rate futures contract. One of his creations from that period, the Treasury bond futures contract, is now the most widely traded interest rate future in the world. He has led the revolution in environmental markets, developing the first spot and futures market in sulfur dioxide emissions allowances, creating the first organized markets for greenhouse gas emissions reductions. And in 2015, Dr. Sandor established the American Financial Exchange, or AFX. It is an electronic marketplace for small and mid-sized banks. AFX launched and created an index interest rate future set by market forces, or an American market-based counterpart to Libor. It's called the Libor Index. For all this not enough, Dr. Sandor is also the Aaron Director Lecturer at the University of Chicago Law School, where he regularly teaches a course on financial innovation and environmental markets. It's a delight to introduce him, Dr. Richard Sandor.
Tom, thank you for that very, very generous introduction. I couldn't be prouder than to be part of the University of Chicago and every value that it stands for, to work with you in the field of law and economics with my fellow colleagues. I want to thank you in particular and the law school for convening this series, thanking Becker-Friedman, etc., for its support, and to thank R.J. O'Brien and Straits for being gold sponsors of this particular lecture. Tom described AFX, and it is a peer-to-peer fintech that creates overnight transactions and other short-term tenors for which the basis is a benchmark called Ameribor. It has grown dramatically since 2015, when we had 10 members and 8 million a day, to 203 members and billions a day, 3 trillion total assets of its membership, including community, mid-size, and regional banks. And importantly, it is a vertical business model, and that vertical business model is associated with over 60 billion in new credit available among our banks. So as opposed to an upstream model, this is a peer-to-peer model. We've been building on the concepts of the University of Chicago. Our motto says it all. We're based on commercial logic and social values. And our mission is to challenge existing models, as you so articulated, Tom, to look at unconventional ways to do business, to champion small people and middle-sized banks that don't normally have a voice and an advocate. It is in this spirit that this seminar is being held. 3 years ago, we decided if we were going to represent those institutions that create jobs disproportionately, we should have gender diversity and minority diversity. And we recruited our first Bank of Puerto Rico in that spirit. We went on over the last 3 years to recruit Hispanic banks, African American banks, Chinese American, Korean American, and most recently Seneca, Native American. And we approached through a great man, Ray McGuire, who introduced us to Kim Saunders, who is speaking today. And we had a meeting at the Chicago Club a couple of years ago, and Kim came into town, and Citibank came into town, and Citizens Trust, Cynthia came into town, and we set out a plan about how we could provide liquidity to the African American banks and other minority institutions. We said then that the number of African American banks in America is 21 out of 5,000 plus. That statistic says it all. Okay, 13% of the population, 21 banks. There is clearly an issue here. What could we do to promote that? And we've given talks, etc. And now we thought that at the University of Chicago to discuss minority depository institutions in the age of COVID-19. Tom, I couldn't imagine a better speaker than we have today. Jelena McWilliams, chair of the FDIC, embodies every single value that we all share. She is an outsider, comes from an immigrant background, incredibly successful, and worked our way through Berkeley undergraduate, Berkeley, University of California Law School, began with very humble beginnings, has a long and vital history. The Senate Banking Committee, Fifth Third, the C-suite for a woman in the commercial sector, and then chair of the FDIC. Equally important, when we spent an hour together, I couldn't imagine anything more kindred. We shared so many values, so many stories at Berkeley, and then we subsequently learned about a mutual interest in 19th century daguerreotypes and photography, and that's how I met Ray McGuire on the board of ICP. So there's a thread of fine art, daguerreotypes, and photography that works its way, Tom, through this thing. I would like to ask all of you to join me in welcoming Chair McWilliams, who is a woman who has exhibited great personal qualities, fantastic professional accomplishments, and a woman of great values. Jelena, the chair is yours.
Thank you so much, Richard. And I think I'm just going to put that introduction in my pocket and carry it with me everywhere, because I don't think I have been ever introduced in a kinder fashion. And for that, I'm very grateful to you. And I'm grateful to Tom as well for hosting us today. I've been wanting to come to the University of Chicago for some time, and so to have this opportunity is wonderful. Good morning to everybody, and I'm just very pleased to be here with you today. The opportunity to address these issues is very crucial to us, and the topics before us today are particularly timely. As the COVID-19 pandemic continues to disrupt the daily lives of all Americans, we're particularly mindful that minority communities have suffered disproportionately from both a health and economic perspective, as well as the just general perspective over the last few months. As these challenges remain with us over the past several months, we have also witnessed a nationwide conversation about racial inequality and other social issues that pose difficult questions across a wide range of policy areas, including banking and financial services overall. As the nation's deposit insurer and primary supervisor of community banks, including minority depository institutions, which we refer to as MDIs, the FDIC plays an important role in helping these institutions meet the needs of their customers in communities, especially minority and low or moderate income communities, which we refer to as LMIs. Before I discuss the FDIC's ongoing work in these areas, let me first offer a few words more generally about the necessity of creating a financial system of inclusion and what I like to call belonging. This mission is not theoretical or merely academic to me. In fact, it is personal. As Richard mentioned, I was born, what I like to say, on the wrong side of the Iron Curtain in the former Yugoslavia in the 1970s. And for those on this webcast who have been born much later, this is before the Berlin Wall fell down and when we had to drive to Germany to buy Levi's and to Italy to buy other American products. While Yugoslavia practiced its own kind of communism as the only non-aligned country in the Eastern Bloc, I realized quickly that even in a system built upon presumed equality and fairness, not all were equal. And for my family, that inequality was very real. As I struggled to transcend my place in that society, I increasingly ached for an opportunity to be all that I could be, to realize my fullest potential and not be limited by my parents' lack of wealth, education, or social connections. And from my vantage point back then, there was a faraway place that held the promise of freedom and prosperity. So it won't surprise you that I spent my 18th birthday on a plane en route to the United States with $500 in my pocket that my parents had to borrow. The very next day, I opened a checking account at a bank and deposited all $500 in that account. I then applied for a credit card, but with no credit history and no assets other than the meager $500, I was denied. Instead, I was offered the opportunity to open a secured credit card, and I jumped on it. But if you think about it, the entire concept did not make sense. I was essentially borrowing from myself while the bank held my money as collateral and collected the interest. Except that for a new immigrant like me, it made all the sense in the world. With each swipe of that credit card, I looked like others in the grocery store checkout line. I was still doing mental math to figure out if I had enough available funds to cover my purchase, but if my accent made me stand out, the grocery purchase did not. After 12 on-time monthly payments, the bank released my security deposit. With my newly established credit history, I was able to obtain an unsecured credit card, an auto loan, student loans, and eventually my first mortgage, which enabled me to become a homeowner. As a homeowner, you want clean streets, nice parks, good schools, a safe neighborhood. By becoming financially and emotionally invested in your neighborhood, you become invested in the broader community and its success. You start to belong. While it would be easy to look at me today through the lens of the office that I humbly hold and assume that I must belong, I know what not belonging feels like in this society. I understand the perspective of those who cannot make ends meet despite holding multiple jobs, who cannot qualify for credit, who watch their checking account balance with daily trepidation, who ration heat in winter to lower utility bills. When you have to do all that and still barely survive, it is hard to feel that you belong. You feel disenfranchised instead. So a significant part of my focus as FDIC chairman has been bridging the gap between those that belong and those that do not. Because the FDIC is a bank regulatory agency, we have approached this issue from the perspective of financial services. We know that individuals from low and moderate income communities are often the least likely to have the very banking and financial services they need most. With respect to minority communities in particular, despite meaningful improvements in recent years, the rates for Black and Hispanic households who do not have a checking or savings account at a bank remain substantially higher than the overall unbanked rate. Similarly, Black and Hispanic households are less likely to have Main Street credit, which we refer to as credit products that are likely reported to credit bureaus across all income levels. And savings rates remain lower among these households, which results in greater difficulty dealing with unexpected expenses. These disparities pose challenges to regulators and other policymakers about how best to address them. While we recognize that there is no single solution, I would like to discuss the FDIC's recent and forthcoming initiatives to promote and preserve MDIs, as well as our efforts to encourage innovation and community banks more broadly. Shaped by my personal experiences and guided by a commitment to increasing financial inclusion in traditionally underserved communities, one of my priorities as FDIC chairman has been expanding our engagement and collaboration in support of minority depository institutions. We define an MDI as a federal insured depository institution for which either 51% or more of the voting stock is owned by minority individuals, or a majority of the board of directors is minority, and the community that the institution serves is predominantly minority. Many of these institutions serve low and moderate income communities with unique needs for accessing financial services, and the FDIC's oversight must reflect their critical role in our financial system. An MDI is often the financial lifeblood of the community it serves, enabling individuals and minority-owned small businesses to securely build savings and obtain credit. Although the number of MDIs is comparatively small relative to the total number of FDIC-insured institutions, as Richard pointed out, these banks have a substantial impact on their communities, including through mortgage lending and small business lending. We at the FDIC have embraced our statutory responsibility to promote and preserve the health of MDIs by seeking new and innovative ways to engage with these institutions and better understand their needs. The FDIC frequently engages with MDIs in Washington and throughout our 6 regions with technical assistance, banker roundtables, and networking events to connect MDIs and non-MDIs for potential business partnership. I refer to these events as speed dating FDIC style, and like to say this is not your grandmother's FDIC for sure. Last year, the FDIC published a comprehensive research study analyzing the demographics, structural change, geography, financial performance, and social impact of MDIs over a 17-year period ending December 31st, 2018. Although the study found improvements in MDI's financial performance, it also observed that many MDIs face greater economic challenges than non-MDI community banks. To address some of these challenges, the FDIC has done a number of things, including tripled MDI representation on our Community Bank Advisory Committee, established a new MDI subcommittee on the Community Bank Advisory Committee to highlight the work of MDIs in their communities and to provide a platform for MDIs to exchange best practices, enabled MDIs to review potential purchases of a failing MDI before non-MDI institutions are given this opportunity, and clarified that non-MDIs can receive Community Reinvestment Act credit for their collaboration with MDIs. We have also facilitated commitments to support MDIs, including most notably a $100 million commitment by Microsoft, for which we are very grateful. Notwithstanding these important steps, we recognize that we can do more, and more, in this case, will require us to think outside the box. One of the options we are exploring to support MDIs and Community Development Financial Institutions, or CDFIs, is a framework that would match these banks with investors interested in particular challenges and opportunities facing those institutions and their communities. We may or may not have drawn inspiration from a successful television show whose name I'm not supposed to mention, in which entrepreneurs present their business ideas to a group of potential investors, and then those entities get the investment. Although we are still developing the details, the idea would include a vehicle, an investment vehicle, through which investors' funds would be channeled to make investments in or with MDIs and CDFIs, including direct equity, structured transactions, funding commitments to loan participations, or potential loss share arrangements. This initiative seeks to accomplish several objectives, including maximizing the benefits to MDIs and the communities they serve by providing capital preservation and growth, as well as providing a minimal return to investors. We expect to release more information in the near future, and we will continue to work with stakeholders on how best to proceed. But as I like to say, you heard it here first. Encouraging innovation to support financial inclusion has been also a great emphasis at the FDIC. As we considered additional ways to create a more inclusive banking system, we must recognize the tremendous benefits that financial innovation can deliver to consumers, including the areas of payments and credit. New technologies have the potential to bring more people into the banking system, provide access to new products and services, and lower the cost of credit. Perhaps no issue is more consequential to the future of community banking than technological innovation, and regulators cannot simply stand on the sidelines and wring our hands. We can foster the development of new technologies that improve the way banks operate. We can encourage banks to engage with fintechs and other stakeholders to ensure that institutions are comfortable offering innovative products and services consistent with safety and soundness principles and consumer protection laws. And we can work to remove unnecessary barriers that create operational and regulatory uncertainty for institutions that want to innovate but are reluctant to do so. For community banks, including the MDIs, the path to innovation may seem daunting. The cost to innovate is often prohibitively high. We recognize that. These banks may lack the expertise, information technology infrastructure, or research and development budgets to independently develop and deploy their own technology. That is why partnering with a fintech that has already developed, tested, and rolled out new technology is often critical for successful innovation at smaller financial institutions. In this regard, fintechs can serve as great equalizers, but by allowing little guys to compete more effectively while satisfying consumer demand. To help overcome these challenges, we established an Office of Innovation, FDI Tech, in 2019, and began working on several initiatives to promote innovation and support financial inclusion. To help facilitate greater access to credit using new technologies, the FDIC and our fellow regulators issued a statement encouraging the responsible use of alternative data in credit underwriting. Alternative data is information not typically found in the consumer's credit files or the nationwide consumer reporting agencies, or customarily provided as part of applications for credit. Using alternative data can improve the speed and accuracy of credit decisions and help firms evaluate the creditworthiness of consumers who might not otherwise have access to credit in the mainstream credit system. Similarly, we worked with our fellow regulators earlier this year to issue principles encouraging financial institutions to offer responsible small dollar loans to customers for both consumer and small business purposes. We recognize the important role that such loans can play in helping customers meet their ongoing needs for credit due to temporary cash flow imbalances, unexpected expenses, or income shortfalls, including during periods of economic stress, national emergencies, or disasters, and certainly during pandemics like the one we find ourselves in. Small dollar credit products and the use of alternative data in underwriting can create a powerful combination for low and moderate income consumers. Our new guidance documents can help encourage FDIC supervised institutions to offer products to existing and potential customers consistent with safe and sound banking principles and consumer protection laws. We're also working on numerous initiatives to facilitate partnerships between fintechs and banks. These partnerships are particularly important to financial inclusion, allowing banks to partner with fintechs that have already developed innovative products and underwriting methods that banks can quickly and safely adopt to support their customers. To help encourage these partnerships, the FDIC issued earlier this year a guide for fintechs and other third parties looking to work with banks. Using the guide, fintechs that may be new to bank partnerships can gain a better understanding of applicable risk management principles and the due diligence processes banks generally follow to meet them. More recently, we asked stakeholders to comment on a groundbreaking approach to facilitate technology partnerships. Our request for information proposed a public-private standard-setting partnership and voluntary certification program that would help reduce the cost and uncertainty associated with the introduction of new technology at an institution. Risk management is an important component of third-party partnerships with banks, but the onboarding and due diligence process can be costly and time-consuming for both banks and their potential technology vendors. These challenges are often amplified at community banks with tight budgets and limited technology expertise. The costs are also high for technology firms. Each bank often has a somewhat different approach to due diligence, and the paperwork and review requirements for vendors are multiplied at each new institution. There's a lot of inefficiency in this process. The voluntary certification program we have proposed would create a standard-setting organization, or SSO, to establish standards for due diligence of vendors and for the technologies they provide. The FDIC would participate with industry and other stakeholders in the development of these standards. Fintechs could then voluntarily submit their organization and technology to an independent certifying organization to verify conformance to the applicable standards. In turn, banks could rely on this certification to onboard the vendor and integrate the technology into bank operations. Standardizing the due diligence process and removing regulatory and operational uncertainty surrounding technologies could fundamentally change the way banks partner with technology firms, and frankly, how they offer their products. Public comments on the request for information are due next month, and we look forward to reviewing recommendations from interested parties as we consider next steps. Additionally, we're working on amendments to our broker deposit regulation that, once finalized, will remove regulatory hurdles to certain types of innovation between banks and fintechs. These are only a few of the steps we're taking to facilitate the introduction of innovative technology into the banking industry. We expect these steps to make banks more efficient and to help introduce new products and services to the market that are safe, affordable, and accessible. For our most vulnerable communities, these new products can be a lifeline in troubled times. But technology is not just about access to affordable credit. New technologies can also form the basis for an ongoing relationship with a bank and the financial system, frankly, a relationship that can open new doors to financial security and economic opportunity for those consumers who most need it. Looking back at my early days in the United States, that secured credit card I obtained in 1991 what was one of the pivotal first steps on my long journey to belong in this society. Over time, I learned how to make the financial system work for me, how to manage credit so that banks would seek me instead of me seeking them, and how to make credit decisions that would allow me to prosper in the long run, including by becoming a homeowner. I'm profoundly grateful for those early experiences, not only because they shaped me in more ways than I can recognize, but because they have allowed me to look at our laws and public policy more holistically. I understand the critical role that banks play in enabling individuals, especially those from low and moderate income communities, to build a better life for themselves and their families. I believe that millions of unbanked Americans could benefit by becoming part of the banking system and learning how to make the system work for them. Our job as regulators is to ensure that banks do their part in making that feasible. In the long run, our society will be better off if these millions of Americans feel like they belong. There is still much work to do to effectively tackle the problems and hardships many Americans face and to address disparities in our society. Both as fellow Americans and regulators with power to shape public policy, we must harness innovation to bring more people into the fold. We need to ensure that our regulations and policies encourage financial institutions to think creatively about reaching out to unbanked consumers and providing products and services that will keep those consumers banked and in the fold. Regulators need to ensure that the financial institutions at the forefront of those efforts, as MDIs have been for decades, can continue to do so. And that will require creativity and sustained effort that FDIC stands ready to provide. Thank you again for the opportunity to be here today, and I look very forward to a productive conversation. Thank you.
Jelena, thank you very much for those remarks. They were insightful, and we would now like to have a open roundtable, and that will be moderated by Giancarlo, who is a former chair of the CFTC, and will include you as the keynote speaker, and Kim Saunders, who leads the NBA, the National Bankers Association, which is the voice of minority depository institutions. I would like Chris, who is on the board of AFX, to please lead the discussion and to serve as the director of this very important panel. Chris, can I hand the reins over to you?
Indeed, Richard. Thank you very much. Thank you for this opportunity. Jelena, thank you for those stirring remarks. Enormous detail, but also a great deal of passion behind your concerns. And Kim, it's delightful for me to be with you. Your work at the NBA is important always, but I think particularly important at this time in the work that you do. And I want to ask you a few questions, but I do want to just turn to Jelena to begin just on one reflection from the remarks she just gave. And that is, Jelena, I know when you started the FDIC, our tenures in government overlapped at that time. I got to know you not just as a brilliant colleague, but also as a friend and one of the greatest wits in Washington. And that's one thing that I'm not sure that everybody who hasn't quite experienced that until they do. And I came to enjoy that great, almost irreverent side of your ability to experience, to go through the Washington experience, and I treasure it greatly. But you spoke very movingly about that notion of not belonging. And so if I could just ask you to take a moment more and reflect on that concept in light of the need for greater financial inclusion in the marketplace. How is it that feeling of not belonging that was so present in your early life has made minority inclusion a priority for you today at the FDIC?
It's a great question, and frankly, it's a profound question. I have to tell you, when you grow up elsewhere and you come to the United States, you see two United States in movies. when you live abroad. And so you see the United States of what I like to say, and I'm going to age myself, but I already told you when I was born, of, you know, Dallas and Dynasty, these shows with big houses and people who are super successful, they have nice cars and comfortable lives. And then you see on TV, you see people who are truly living in abhorrent conditions in a very rich country. And so you try to juxtapose those two systems within the same society. And I have been I spent a lot of time thinking about this. And when I first came to the United States, you know, I had $500. I lived with an American host family as an exchange student for 1 year. So I had food and shelter, but then I was on my own. And when you're making, you know, back then it was $4.25 an hour for a minimum job and holding 3 jobs and still being unable to pay bills, you actually don't feel like you belong. You feel that there is them versus us. And that feeling of them versus us can be antagonizing at times, because no matter how hard you work, you just can't make ends meet, and you don't see the light at the end of that path. And for me, the light was really education. I knew that, you know, I could be hungry, I could have no money for clothes or for food, but I'm going to get educated in the United States. And it was frankly at a great expense. You know, Richard mentioned I went to University of California at Berkeley. I couldn't actually afford to live in Berkeley. And when I was applying to colleges, I was down to $50 from my $500. And having lived in Stockton, California, in central California, in a rural area, I wanted to apply to Berkeley and Stanford application was $60 at the time for undergrad, and Berkeley was $40. So I ended up, you know, one application, and I got in, but I couldn't live there. So I drove every day 80 miles each way. 160 miles to make it to my classes. But education was that important to me. And in the end, I wouldn't be here today if I didn't get educated. But I came from a system that even though my dad was born in 1925 and he got pulled out of school when the war broke out in 1941. So he actually got pulled out of school earlier. So he never even went to high school. And my mom was pulled out. She was born in 1941 as Yugoslavia was being carpet bombed. And so educating girls was not a priority back then. So she had something equivalent of a third grade education. So even though I come from very and I don't mean this in a demeaning way, but very uneducated people, they stress education for me. So education was that equalizer for me in the United States. I sounded different. I didn't sound like I was born here. You know, I obviously didn't have background and a support system in the United States, but I got educated, and I got educated at one of the premier institutions in the United States. And that allowed me then legitimacy. And with that legitimacy, I started to belong. And so I do think that for communities that are experiencing that not belonging and generational not belonging, I think educational institutions, certainly University of Chicago, has made great strides to provide a path for them through education, but not all of them will have that opportunity. And so I do look at this, and then I look at the financial institutions that serve those communities, and when you can't get credit, it becomes very difficult to function in this society. If you don't have enough money and you can't get credit to not just financially prosper, but to make ends meet, you certainly don't feel like you belong. You know, you go to places that are kind of a seedy. I've gone to some of those places, and you kind of look over your shoulder, you know, cashing your check or being able to pawn your items. And it becomes very, very difficult to exist and feel your humanity in a system like that.
Wow, that's so powerful. Kim, if I could turn to you, but continue along this lines of the sense of not belonging. Your member firms are on the front lines of serving communities that have traditionally felt as if they do not belong. And one of the ways that your member firms do that is simply by the presence of physical branches in areas that have traditionally experienced credit rationing and traditionally low access to finance. Can you talk a little bit about that value proposition of your memberships of actually serving local communities by being present in local communities and giving the community members a sense of belonging by access to a physical branch?
Yes, first of all, Chris, I want to say thank you. And I want to thank the University of Chicago and Dr. Sandor and American Financial Exchange for this opportunity to join you on behalf of the Board of Directors of the National Bankers Association. I'm honored and humbled to be a part of this esteemed panel today. I want to thank our chairwoman, McWilliams, for those amazing remarks and the support that she provides to our sector. Chris, your question is a critical one. And I want to thank the FDIC for their recent 2019 study and also the 2014 study that they did on minority depository institutions. When you look at that study, Chris, it validates the point that you're making, that our institutions are present and that presence is critical. We're more prevalent in low to moderate income communities than non-minority depository institutions. And when I was CEO of a bank, we actually had an advisory board of millennials. And one of the things that they said was that, and we know that technology is critical to them. Many times we say they don't want to come into a branch, but one of the things that they said was that it was important to us, your bank is present, that we can literally come in when we have a need and have a problem and talk to somebody. So this concept of our banks being present physically in low to moderate income neighborhoods is important, because when you have a question, when you're trying to learn, as our chairwoman spoke about, the financial system, it's important that you have someone that you can have a face-to-face conversation. Our bankers are very much like, I call maybe the Ritz-Carltons of the world, because when you call down or you call to the bank, we know you so intimately, we know you by voice. And there are countless stories, countless generations that have benefited from our institutions being physically present. We have financed and supported so many businesses, institutions, car loans, home loans, et cetera, because we were physically present. I can also say that because we were physically present, we were often the first movers of banks in those locations. And once we located there, then the majority banks started to come in. So our physical presence has been critical, is critical to the communities that we serve and their economic development. Thank you.
Thanks, Kim. You know, if I can just pick up on that, another area in which your member firms are particularly effective is supporting your communities with purchase mortgages for home ownership. And that is so important for the stability of your communities that you serve. And Jelena talked about this as well. Could you just amplify that a little bit? Talk a little bit about the role of your member firms in local mortgage lending and why they're able to be so effective in that area.
So there are a couple of things there. And again, I thank the FDIC for the study that they did, because these are not just anecdotes. The study shows, they've done the research to show and validate that if our institutions were not there, the ability of our community to obtain home mortgages just literally almost would not exist. The disparate treatment between majority banks and minority banks and their ability to deliver mortgages is just really appalling, quite frankly. But it speaks to the value that our institutions provide. And we all know that home ownership is literally the first step to wealth creation in this country. You have got to have ownership of a home or a business in order to truly create generational wealth. And so our institutions, pound for pound, provide more of these mortgages, as you mentioned, Chris. And a lot of times, in order to create first-time homeowners, again, there's a need for technical assistance and support in helping to pull together the information that's needed. As the chairwoman noted, oftentimes you have to rely on alternate data because there may not be the type of credit history and report that is needed to support that mortgage. Many of our institutions may provide portfolio loans to get homeowners started on the path to home ownership in a long-term fashion. And I often say, of course, we are not predatory lenders. When we provide a home mortgage, I'm a former chief credit officer and lender. I often say, you have to sleep and I have to sleep. So we're going to put you in a mortgage that we know is affordable and that will work for both of us. And that extra care, time, attention is an expensive way to deliver financial services, but it is necessary when you're trying to create this first generation or second generation of wealth owners, if you will, and holders in a community.
And that's such an important mission. Jelena, you really have opened the door to the use of alternative credit and analysis in a way that is so important right now. One of the other things you did is created a minority deposit institution subcommittee to the FDIC's Advisory Committee on Community Banking. Could you talk a little bit about the objectives of that FDI subcommittee and how's it going and how does it contribute to what Kim talked about in terms of making home ownership available for communities that have traditionally not enjoyed it at the same rate as other Americans?
Sure. And for a second, I'll go back to the alternative data. And I have to tell you, a few years ago, I was a skeptic. I was thinking, well, is it as good as the credit data, right? And then I realized the potential for alternative data to, frankly, if used responsibly, to provide credit for people who may not otherwise qualify. And that automatically brings a ton of people into the fold. You know, I say into the fold, but it's essential that we're able to use something like that and allow our banks to use something like alternative data in their credit underwriting practices so that we can expand home ownership in America and expand the use of credit. And you know, I when I think about, you know, to Kim's point about home ownership, if you don't have credit history and you can purchase a house for cash, which very few people can, you're not going to have a home. You're going to rent, so you'll have someplace to live, but you won't have that home, and you have nothing to pass on to the future generation. And when I talked about, you know, when you're a homeowner, you're invested more so in your community than you're otherwise, because not just for nostalgic reasons of the emotional value of what the home represents, but because you don't want your home value to go down. You made a major purchase in your life. So it's almost like the ecosystem of one thing leads to another, and that's frankly what have been missing, particularly in the African American home ownership community. And so we created the MDI subcommittee on our community bank advisory committee because frankly I thought it was important to have a separate body just for those voices. And here's why. We are seeing economic disparity in the United States, and we want to see more of the equality across different ethnic groups and races and socioeconomic I would say classes, but then I'm being too European if I say a class. But we do have a system of multiple classes in the United States, whether we recognize that or not. And bringing those voices at the same table so that they can both collaborate amongst themselves and also present a unified front in our efforts at the FDIC on how we can help them reach to the non-FDIs, what Kim calls the majority banks, to partner up, and for the majority banks to understand what benefit they can get by partnering up with these small MDIs is crucial, frankly. So we wanted to provide a venue, and that venue, we had, you know, some representation on our community bank advisory council of minority depository institutions, and we tripled that. But we also wanted a separate venue so that we have both a framework within which to function, but also an advisory body for the FDIC actions in this place. Because I do believe that if you put the weight and I like to say the brand of the FDIC behind these efforts, more people will come and understand it's legitimate. And if the FDIC is willing to help these communities, so should we be. And as you saw that through the Microsoft commitment we secured for $100 million, which again, we're enormously grateful for, and we are hoping others will follow. And this vehicle that we're considering about creating would be a venue for the entities, non-banks and banks alike, to invest and then have those funds go to the MDI banks.
You know, Kim, Jelena spoke in her remarks about the role of fintech, and I think there too, the FDIC has been very forward-leaning in their approach to this. Their guide for fintechs to work with MDIs, I think, is really groundbreaking, and they're opening the door to this. Could you talk a little bit about how your members are reacting to this initiative and whether they see it as an opportunity and are exploiting this opportunity to gain some advantage against the bigger guys, as Jelena referred to them?
Well, first of all, I want to thank again, as you noted, Chris, the chairwoman, for her leadership. It is critical. And our institutions are very excited about the opportunity to utilize technology and to use it in a way that would make our products and services more available to the communities that we serve. And it's our hope really that as we're in this current pandemic and we're having to educate our children through distance learning, that is actually opening up access to technology for more families, especially low to moderate income families. And what that then does, because as we said earlier, our banks are more present in those communities. We know those communities in a deep and personal way. We've been there for generations and decades. We will be well positioned then with technology to expand the services that we provide and the technical assistance and support that we provide to many more families. And we're looking forward to that opportunity. The opportunity that the chairwoman mentioned about performing the due diligence and the vendor review process so that the onboarding of these partnerships is made easier and more seamless and consistent will also be, I think, a critical opportunity for our banks to engage with the fintech platforms.
That's great, Kim. Just on the subject of fintechs, I actually might turn the question over to Dr. Sandor as the entrepreneur behind at least one fintech today and multiple fintechs in the past, that is the American Financial Exchange. Dr. Sandor, as you know, the demise of Libor was never meant to result in its replacement with a singular benchmark. There are alternatives to Libor, such as SOFR, which has been endorsed by the Alternative Reference Rate Committee, and that reflects the funding costs of large Wall Street banks that are primary dealers of U.S. Treasury securities. But there are other alternatives, such as the Ameribor rate, which has been developed by the American Financial Exchange, that is used increasingly by America's regional, community, and minority-owned banks, including by NBA members. And they've spoken out about their need for a broad-based interest rate benchmark that tracks unsecured bank borrowing and lending, which is more prevalent in the communities they serve. So could you talk about why an interest rate benchmark based upon unsecured bank lending plays a crucial role in ensuring fair pricing on credit provided by minority-owned banks to the real economy of homeowners, of small manufacturers, of car dealers, of equipment builders, et cetera?
Thank you, Chris. I'm happy to answer the question. The minority community needs to create assets that are linked to their cost of borrowing, and a benchmark that is based on overnight unsecured lending does that. Kim's point about the reach is really critical. There's not too many big banks like Citizens in Atlanta that will lend $400 in a single loan in the PPP program. The big banks don't have that reach that Citizens have, that Unity, a small car dealer. And if they are to do efficient asset liability management, Chris, and lend to people, it should be based on where they can borrow. And this is very, very critical. The other key point that is in that vein is we have formed, and Kim is a founding member of, a minority lending coalition. And that minority lending coalition will include Harold Butler at Citibank, who's a friend of ours, as well as B of A and all of our member firms. And the hallmark of that is to give these banks participations in loans that float to Ameribor. And the idea is that cost of borrowing is overnight unsecured. Their portfolio should consist of that. we think, and I think Kim stands by it, this is not only a time for action, this is a clarion call for banks to slice off 1 million or 2 million. They're flush with liquidity like the entire banking system. They need participations. They need the kinds of things that Jelena has so eloquently spoken about. It's time for all of us to partner, to take that extra step, and to make their balance sheet sustainable. It is a business issue. They can't reach and lend $400 unless they have an interest rate spread that makes sense. It is, all of the talk is not really relevant. It's the job is to build the balance sheets of their businesses, and it is not, as Kim and I have talked, not giving away fish, but having people learn to fish, as Kim told me. And that's the business we're in. And particularly hallowed institutions like the University of Chicago. Tom, that's what we do. We educate, right? We teach, we build human capital. And Jelena's talk so hit on building education and human capital as access. This is why we're here today.
Thank you, Richard. That's terrific. Well, Jelena began the conversation about belonging. I think that not all of us can have the honor of belonging as alumni to the University of Chicago, but for at least for an hour today, we've had the opportunity to feel as if we have that privilege and that opportunity to be with everybody today. So I'm grateful for this opportunity to have this wonderful dialogue. And Richard, I'm going to hand it back to you to close us out with some final remarks. For me, thank you very much. It's been a pleasure.
Chris, thank you very much. Kim, thanks a lot. We're going to work on this together and be more than idle words. Tom, thank you so much for hosting and facilitating. On a sentimental note, I think Ronald Coase would be really smiling at this whole conference. And on a sentimental note, we lost one of our co-directors, Carol Brookins, to COVID-19, and Carol would be smiling too, Chris. You know, she would have loved this conversation and probably is angry that she's not here physically, if we know Carol. And a personal thank you to Chris, to Art Kelly on our board, to Andy Lowenthal, to Robert Albertson, to our leaders who are working on this syndication loan with us and are going to make some reality to building African-American bank balances. This is truly a pleasure. We're going to have leading authorities, regulators, famous economists in this series. We believe that the best idea is a free market for ideas, as Tom indicated, in transparencies. I think we would like to invite you to attend these personal seminars. And in trying to keep with that, we may have, Chris, would you entertain a question or two, if we could, a quick two. It's 11 o'clock and we have a couple of unanswered audience questions, and then I'll wrap it up.
Absolutely. Iris, direct me to, I have one in the Zoom chat. Is that the question? Well, yes, I'll put that to the, good, then
there are
great,
two
thank
questions.
you.
Feel free to read this one out, and then I'll bring on another audience member once you're finished with that one.
Thank you very much. So the question from the audience, from Remy forgive me, is what types of information comprise the alternative data that MDIs use and the FDIC proposes to use in its new initiative?
So I can take that one, and Kim, as a former credit officer, can probably provide her perspective as well, equally well. So when we talk about alternative data, it is something that's not traditionally credit. So we're talking about cell phone bills, because we know that even people who, the poorest in this society, have a cell phone. Why? Because it's their access to the world, right? That's how they function, that's how they communicate, that's how they do their, I would say, financial services, even if they don't have a bank. So they do make their monthly cell phone payments. You know, it's a utility bill. It's if they have a say a car loan from a place that doesn't furnish information to the credit bureaus, but it extends its own credit. You know, usually those are the dealerships you see on the corner of the street. And they extend their own credit, but they don't report necessarily to the credit reporting bureaus. That too would be alternative data. So it's a mix of both traditional credit that doesn't get reported as we like to say, furnished to the consumer reporting bureaus, but also the type of financial obligations that do not constitute traditional credit, but obligate a consumer on a monthly basis to meet those bills. So that's kind of the broad definition of alternative data.
Thank you. Kim, would you like to amplify any points there?
The only thing I'd like to add is, again, through the use of technology, the ability, and with regulatory support, the ability to incorporate this into the underwriting process in a more consistent manner is welcomed. I can tell you, as a former mortgage lender, you know, I would have to do these things by hand and with bank statements and trying to put it all together. And so I'm excited about the initiative that the chairwoman has in place, and know that it can make a difference in the provision of mortgages in the country. So
thank you. I have another question from Jacob Leshno to all panelists, and that is, what is your perspective on barriers to entry in payment services and to the high valuations of payment providers? Does anyone want to take that one?
Chris, I missed the first part. We had a little technical glitch. I missed the first part of the question.
Yeah, so the question is, what is your perspective on barriers to entry into payment services?
Oh, well, I would, if I can start, but I mean, I would say that it's the plethora of other companies that are in that space, right? And so you have the challengers who are in the payment space. You have some of the long-established companies that are in that space as well. There's a lot of, I would say, discussion in Washington about who should control the payment space, and I won't go any more into that because it's a political debate here, and I've learned that politics is quite often the third rail, so you just don't want to step on it. But I would say that for companies entering this space, you're looking at a somewhat saturated field. So if you're not offering something new, something innovative, something that's going to reach a segment of the industry that others are not reaching, or a better solution for a segment of the industry, you're probably not going to be successful as a market participant. And as a consumer, I would say you have a lot of choices. And as I've learned in America, you know, back in Yugoslavia, you would go to a grocery store and there would be two soaps and you can pick soap A or soap B. You know, you walk into American grocery store, there are like 51 soaps and you don't know how is soap A different from soap B, from soap C, you know, and so on. So I think that consumers can get stifled by choices, which, you know, we think choice is good, but it requires knowing how to be a savvy consumer and how to dissect information to see which products are better for you and which products actually may be you know, not as good or even potentially predatory. And that's something that on a regulatory side we look at, but also as a consumer that requires a level of education and savvy.
Thank you very much. Kim, thoughts on payment service providers and how your members might react to the plethora of choice that Jelena referred to?
Well, I would agree with everything that's been said. Certainly, there are a lot of, if you will, companies that are in the space, trying to engage in the space. I will say there's also a lot of concern because of the, I would say, unevenness, if you will, and the lack of oversight, so that there is transparency about what are the best choices and the safest choices. Because as we know with technology, there always is risk, and you have to manage the risk associated with payments. So this is an area that is complex. There's not a simple answer to that question. And then the valuation issue, how you value a technology firm is different. And so when you talk about valuation, that has its own sort of characteristics and components when you come to look at how to value a technology firm. I would also say that in the banking space, for many community banks, there's just a handful of core processors, and that limits those banks' ability to be as innovative as they would like to be in many cases. And so there's a lot of work, I think, to be done on both the regulatory side and the industry side to really provide state-of-the-art services and to make sure that they are available to all consumers and companies in the country.
Thank you, Kim. We have one more question, and if we have, I hope we have time for it, and that is, how would smaller banks currently begin to take part in the program that Jelena talked about at the FDIC with fintech companies to innovate operations?
Kim, if you want to go first, I'm happy to go second.
Well, I do know that the chairwoman, as she mentions through her subcommittees, is engaged in a direct basis with our banks and community banks, and that allows us an opportunity to weigh in and to work together in a strategic and partnership manner. Also, the NBA has enjoyed a long-standing relationship with the agency, and we appreciate the opportunity to work together and to work closely as we look at the future and our business model. I'll turn it over to you.
Thank you, Kim. And I would say from the FDIC's perspective, this is something that we have just unrolled. And the idea here is to cut through the red tape. We don't need every fintech that wants to partner with a bank to go through the same first, say, 50 steps. You know, we want them to have those 50 steps certified through this public-private partnership, and then to bring that information to us. As they're onboarding these fintechs, and then there will be extra due diligence that's required based on the ad hoc model that fintech presents or the unique nature of it. And as far as how would companies know how to partner up, we're in a preliminary stage of this. We have just issued a request for information on how to set up this public-private partnership. We're frankly going to be looking for institutions, academic institutions, et cetera, who can do this type of work and who could become trusted partners for the FDIC here, and then we'll develop the certification program and unroll it. And when that happens, we will have the ability. I would say we're slightly away from that, as it may take a little time, but I have about 2.5 years left as the chairman of the FDIC, and certainly we're going to accomplish this well before my tenure is done.
Fantastic. We do have a comment from Stephen Hawk to all panelists, and it says, "Thank you all, inspiring words. Makes me proud to be a banker in the United States and have hope for our collective future." I think we share that view. Was that?
Chris, can you hear me now?
Yes, indeed.
Thank you. This is Rodney Rushing with Service First Bank in Birmingham, Alabama. And I want to first thank Chairman McWilliams. You met with us in Washington when Alabama Bankers visited. Not only did you attend, you were very engaged, and it was noticed thoroughly. So thank you for that. My comment is, about 6 or 7 months ago, y'all had the roundtable discussions that you were talking about. You had one in Atlanta. Betty Rudolph, Tania Major, and I think Misty Mobley were there. And we met with many of the CDFIs and MDI banks. And we're a correspondent provider. We have over 300 community banks have accounts with us. 21 of those are MDIs or CDFIs. And as a result of that roundtable, we invested some CDs and overnight investments with some new relationships, over $1 million in new relationships. And there are other things as a correspondent provider we could do and want to do. Issuing credit cards, customized credit cards for banks. We do that for 100 downstream banks. We would love to explore. And so my request is that if y'all could do a follow-up, would there be a way to have a follow-up to those roundtables? Maybe meet again, maybe meet in Washington.
Yep.
But we are eager to do that.
Yes, no, thank you, Rodney, and thank you for that. This is for those who weren't partaking in this. This was the FDIC speed dating thing I mentioned. We didn't call it speed dating, but that's really what it was. Where we put the MDIs and the non-MDIs together and literally rotated them around tables to see if there is a potential for a symbiotic relationship. And we have, thank you, Rodney, for mentioning that we have been able to create quite a few of those. I would say, yes, absolutely. We were planning on actually kind of a round 2 of all of that. And then the pandemic came upon us. So as we're adjusting to doing a lot of things remotely, we're going to consider ways how to continue that work. And frankly, we have even more things planned, and realizing now that the pandemic and the lockdowns may last some time longer, we're going to kind of switch all of that online and announce how we're going to do it. So yes, thank you for those encouraging words, and I'm glad that something good came out of the Atlanta roundtable.
Thank you.
And Chris, if I may, Rodney, I would like to just ask you, I'd love an opportunity to reach out to you and talk a little bit about the National Bankers Association and the corporate strategic partnership relationships that we have that might be of interest to you, since you're interested in working with the minority banking sector. So I offer my information to you at nationalbankers.org. You can just reach out to us and we'll follow up with you as well.
Jelena, I'm glad to see that your speed dating exercise is still resulting in more dating going on. So that's terrific. Well done.
Hey, if you name it speed dating, people come.
Yeah, exactly. So I think we've reached the end of our questions. Again, Richard, I'll pass back to you unless there's anything else. It's been from my point of view, this has been a fabulous conversation and very, very informative and very forward-looking. So my thanks to Kim, my thanks to Jelena very much. Richard?
Yeah, I want to thank you, Chris, for doing it. Thanks again to Kim. Thanks to the folks who asked questions and participated. Remy Kwame Kane, who represents one of our African-American minority depository institution, and Stephen Hawk and Jacob Leschno, and thank you all for your participation. I want to conclude, of course, and save the best for last, and that's the thank you to Jelena, who, has a 5-year term, so she will be in her position for some time. I'm hoping that her career ends in positions even as some in the highest of the land. And she's a woman of great expectations, as Charles Dickens said, and we are proud and humbled to have her here at this seminar at the University of Chicago and the law school and the Becker-Friedman, and thanks again to the university for hosting this event. Everybody be well, stay safe, and stay tuned for a lot more events like this. We're gonna have some fun, and we're gonna bring some challenging issues, and we're gonna walk the walk and talk the talk, Kim. Count us to be around for the African-American banks. We want to do things that materially affect people's lives in a positive way. Thank you all very much, and stay safe.